Good morning, students. Today we are going to discuss investment avenues. So what are the investment avenues available in the capital market we are going to discuss today? So these are the four investment avenues capital market. First one is equity shares. So what is equity shares? Who are these equity shareholders? What are the benefits of equity shares? Okay, one by one we are going to discuss. So equity shareholders are the owners of the company. They contribute capital for the company. Equity share capital is also known as risk capital. Why it is known as risk capital? Because equity shareholders mainly looking for capital appreciation, and it is also known as a long-term capital. There is no maturity for equity shareholders. So in case equity shares invested as a shareholder in the company, or shareholders invested in the company as an equity shareholder, so they have to wait for long period of time. In case company earned huge profits, so they will be getting profits in the form of dividends, okay, revenue in the form of dividends, and if shares are listed in the stock exchange, that is the case, the market price increases, so they will earn revenue from the investments. But in case, suppose a market prices are coming down, so that is the case, they have to lose their investments. That's why it is risk capital. There is a one proverb: you are taking more risk, more profits, more returns. If you're taking less risk, less returns. So that's why equity share capital comes under risk capital. Okay. Next, what is preference shares? Preference shareholders are the shareholders. They're having preferential right to receive capital and dividend in case company close the business, or after completing the maturity period, they will get their capital back. Preference shareholders having maturity period, preference shares having maturity period. And in case company is under loss, they're closing the business, then they will get priority to receive their capital back and also dividend. Whenever company issue dividend, okay, first they are going to pay preference shares, then they are going to pay equity shareholders. If you compare equity shares and preference shares, okay, equity shares will have their own advantages, preference shares have their own advantages. So what are the advantages? Comparatively, equity shares will have capital appreciation, preference shares don't have capital appreciation. So equity shares, okay, they will get capital appreciation as well as huge rate of dividend, and they don't have maturity period, and preference shares have maturity period. That is the advantage preference shares. And in case company is under loss, preference shares will be given preference to pay back the capital. So that is equity shareholders and preference shareholders. One more advantage: equity shares have voting rights and preference shares don't have voting rights. Equity shares will participate in the management of the company to appoint directors of the company. Preference shareholders, they don't have any voting rights to appoint directors of the company. So that is equity shares and preference shares. And what is debentures? So debentures are in the form of certificates. So it is also known as a loan capital. So debentures can create charge on the assets of the company. It is simply like a loan capital. Instead of taking loan from the company's financial institutions, companies can take loan, borrow money from the public. That is only known as debentures. What are the features of debentures? Debentures carries fixed rate of interest. There are different types of debentures, okay, and it is having maturity period. Whatever may be the profits earned by the company, whether company under profits or loss, they will get fixed rate of dividend annually, quarterly, or off yearly.